Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ANNEXON Inc. Annual Report. ANNEXON Inc. is a biopharmaceutical company focused on developing treatments for inflammatory-related diseases. The company's pipeline includes several promising candidates that are currently undergoing clinical trials. One of the key products being developed by ANNEXON is tanruprubart, an investigational monoclonal antibody in Phase 3 clinical trial for treating Guillain-Barré syndrome. Additionally, the company has completed a Phase II clinical trial for Huntington's disease and is conducting a Phase 2a trial for amyotrophic lateral sclerosis. ANNEXON is also developing an X7, an antigen-binding fragment, Fab, that is in Phase 3 program for geographic atrophy treatment. Furthermore, the company is working on an X15-2, a novel oral small molecule inhibitor, which is currently in Phase 1 clinical trials for autoimmune indications. In addition to these products, ANNEXON is developing an X9, a C1q blocking Fab that is in Phase I clinical trial for treating patients with lupus nephritis. Overall, ANNEXON's diverse pipeline of treatments holds promise for addressing various inflammatory-related diseases and improving patient outcomes. ANNEXON Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. ANNEXON Inc. trades at a higher price-to-book ratio of 4.04 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 24% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, regulatory approval of product candidates is a significant driver, as it enables companies to commercialize their products and generate sales. Commercialization activities, such as marketing, sales, and distribution, also play a crucial role in driving revenue growth. Additionally, successful completion of clinical trials, milestone payments from license or collaboration agreements, and the ability to secure alternative manufacturing facilities are other key drivers. On the decline side, failure to receive regulatory approval or successfully commercialize product candidates is a major driver of revenue decline. This can be due to various reasons such as ineffectiveness in treating certain types of disease, delays or increased costs in completing preclinical studies and clinical trials, or competition from established companies with greater resources. Limited market penetration due to strong competition and regulatory hurdles also contributes to revenue decline. Furthermore, difficulty in obtaining adequate coverage and reimbursement for products can also hinder revenue growth. In summary, the primary drivers of revenue growth are largely dependent on successful product development, commercialization, and regulatory approval, while revenue decline is often driven by factors such as failure to receive regulatory approval, competition from established companies, and limited market penetration. The net income of the company experienced a decline between 2024 and 2025, with a loss increasing from $138.2 million to $206.7 million. This decrease was attributed to several factors, including reimbursement reductions from the Medicare program, price ceilings on specific products in international markets, disruptions caused by public health crises, potential loss of regulatory approval, and increased competition from generic versions. The profit margins also underwent a significant change, with an expected decline due to reduced reimbursement rates and increased competition from lower-priced products in foreign countries. Furthermore, the company's implied negative profit margin was evident due to substantial operating losses. Additionally, price ceilings on specific products and therapies in various countries posed a threat to the company's profitability, potentially leading to a decline in profit margins. The company's debt level has experienced a significant change over the past year. According to the financial reports, total liabilities increased from $56,966 in 2024 to $65,923 in 2025, indicating an increase of approximately $8.957 million. This substantial rise in debt suggests that the company may have taken on more loans or borrowed funds to finance its operations. As a result of this increase in debt level, it is likely that the company's interest expenses have also changed significantly. Although there was a decrease in accretion of discount on available-for-sale securities by $5,049, which can be inferred as a proxy for interest expenses, the overall impact of the increased debt level may outweigh this reduction. Therefore, it can be concluded that the company's interest expenses have likely undergone a significant change due to the increase in its debt level. The management of the company is optimistic about its future prospects, driven by the progress of its late-stage registrational programs. The company's two key products, tanruprubart for Guillain-Barré syndrome and vonaprument for geographic atrophy, are expected to file for regulatory approval in 2026. Additionally, X15-2, a promising product candidate, is showing positive results in clinical trials. The management acknowledges that the company will require substantial additional financing to achieve its goals, with existing cash expected to fund operating expenses until mid-2027. To address this need, the company plans to seek funding through various sources, including public or private equity offerings, debt financings, and collaborations. However, the management also highlights several risks and challenges that could impact the business, including security incidents, data breaches, and system failures, as well as uncertainty in the international trade and regulatory environment. Despite these risks, the company is committed to advancing its product candidates through regulatory approval and commercialization, while managing its financial resources effectively. Overall, the management's strategy is focused on balancing progress towards regulatory approval with careful financial planning and risk mitigation. Supply chain disruption concerns. The extracted summaries reveal several concerns regarding supply chain disruptions that may impact a company's ability to raise additional capital, complete preclinical or clinical trials on time, and maintain its manufacturing operations. One potential risk is supply shortages due to quality control problems or enforcement action against contract manufacturers, page 50. Global financial crises and regional political disruptions can also cause extreme volatility in the capital and credit markets, straining manufacturers or suppliers and leading to supply disruption, page 56. Furthermore, tariffs and trade restrictions have the potential to disrupt existing supply chains and delay development timelines, page 57. These concerns highlight the importance of having a robust and resilient supply chain that can withstand various external factors. That concludes the financial summary for ANNEXON Inc. Feel free to comment below, and I will be happy to answer them when possible.